Hi guys, welcome to week 6. I've got Andrea again back this week. Lots to get through, so we're just going to get straight on with it.
Right, so let me guess, we're going to talk about economies this week and that's going to involve inflation.
Well, it's a real treat for everybody this week because it's not just inflation we're going to discuss. There's really a three-pronged attack on equity markets at the moment with macroeconomic issues. Inflation's obviously one of them, but then we've got rates, and we've got not so much a new one thrown into the mix, but certainly a very relevant one that we haven't touched on so far in geopolitics. I'm going to try and lay out kind of the data in the background and then kind of try and explain how it all links together. Inflation just doesn't go away. We know that, and it's not about to go away anytime soon. Obviously, we had the numbers out of the States this week. CPI at 7.5%. That's the fastest rate in 40 years now, 42 years I think it is exactly. At 7.5%, we're certainly not done. There's no signs of that really easing up. And 9% is the next step we're going to go to. Inflation in the Eurozone is currently up 8 straight months in a row, while the UK is really set to move above 7%. Obviously in the UK we've had back-to-back rate increases, we know that. We've discussed where we're going to go year end, and that's 1.25%. That's our call. There is calls at 1.5%, but we're sticking with 1.25% for now. The Eurozone is they're unwilling to really engage in anything right now. They think all of these issues are just going to mysteriously fix themselves. But there was a change of tone from Lagarde this week, and there's mutterings now of a rate increase, but even then, still not until kind of autumn time, looking at October, before they really make any move of any sort. The US is the real one. There's anticipation of 6 rate hikes, kind of, we say priced in, we'll get onto that in a little bit, but there's a lot of anticipation of 6 rate hikes, all at 25 basis points. Again, we covered last week how the job data of a couple of weeks ago, along with the CPI data of this week, they're almost forced to go more aggressive. We don't personally think at the moment that the rate increases will be equal increments. We do think it'll be a half point in March. Obviously, the one thing that's escalated the last few days has been the tensions between Russia and the Ukraine. Especially late on Friday, it really got markets coming backward at pace, really. The invasion of Russia, or intended invasion of Russia into Ukraine, there was anticipation it wouldn't really happen for a few reasons until after the Olympics. Now there's almost an expectation that that will take place prior to February 20th. So that's basically this week coming. If we look at how that might play out, we're not expecting a prolonged full-scale war. We do think it will be a very quick and brief assault on Kiev as the most likely outcome. Obviously the West will retaliate on the ground. They will have to go on the ground. That's kind of a given, but they'll retaliate a lot harder in terms of economic sanctions. And the school of thought we're working with, and we've spoke to people about this, it's almost what Putin wants. We fully believe now this is what Putin wants, the economic sanctions imposed. Obviously it will cut access to Western capital, but he has such a powerful hand right now in the energy crisis that is ongoing in Europe. It almost makes it an ideal time for this to be happening, as crazy as that may sound. The reason we believe he wants the sanctions is because that then gives him a reason to justify it to the Russian people Russia's always been a bit of an outlier when it comes to the West anyway. But we believe this is a route for Russia, Russian government, Russian people to align themselves strongly to the East. If that's the case, you end up with a real commodity powerhouse in the East between Russia and Asia, and that will play itself out in time. We do feel as though an invasion into Ukraine is inevitable at that point, and you will obviously have to react to that.
Knowing where markets are at now, how much of that is priced in?
Well, I mean, we actually see very little of this priced in right now. A few reasons for it. So your inflation is set to continue. I think we just, it's the same old story of the inflation. Huge part of inflation is your energy costs. Obviously, any Russian invasion into Ukraine is just going to intensify that. So the energy part of inflation really isn't going to ease up. I mean, we'll touch on where we think energy prices are going to go in a little while. On top of that, you've got a trend now appearing that companies are getting pricing power. Again, we've touched on that in recent weeks, but with the ability of companies to just keep charging customers more and customers keep paying it. I mean, obviously we will reach an equilibrium point on that, but for now, these companies have pricing power. They're going to use that to create extra profit, and it's going to continue the squeeze even further. The gas and energy prices on Europe is going to hit really hard. And then, of course, you get onto the rates. How much of the rates is priced in? There's just an ongoing argument between, will it be 6 increases of 25 basis points? Will some be 50 basis points with less increases throughout the year? When you're discussing them being priced in, you're almost forgetting that at this point, we've still got QE ongoing. The bond purchases are still going for now. So you haven't got an issue of the rate increases being priced in. They're just not at all, because you've got the QE continuing. And I think it was this week, 30-year mortgage rates in the States. It's very different in the States. They don't take short-term fixed contracts, your 3-year fixed rate. It's a term of 30 years on their mortgage. Mortgage rates this week went beyond 4%, but that's 120 basis points in just 2 trading weeks. That is a huge, huge difference on purchasing power. The 120 basis points increase on an average house in America, that's going to cost homeowners an extra $2,500 a year. So that's $2,500 a year that isn't being spent elsewhere. And of course, that's before it all comes around a circle and the Fed stops with the QE. The moment they stop buying mortgage-backed securities, well, then this rate is just going to go higher and higher and higher. And the net kind of difference come year end is probably going to be around somewhere around $3,500 to $4,000 difference that US homeowners will be paying. And of course, at a time lag, that does filter into corporate earnings. So into equities this week, corporate earnings have offered a lot of support to markets. Quarterly earnings not as strong as they have been in previous quarters, and this quarter might be the last one you see where they really add some support to markets. Due to the fact that it has been a relatively quiet week, whether that's quiet or just quiet compared to previous weeks we've seen, remains to be seen. But with it being so uneventful, we're just going to kind of talk people through what we've picked up this week, and also touch on a few requests that have came in through the various channels.
We only had one real target this week, while others we're taking on circumstances. We've picked up ITM. It's a company we've traded on and off for the past 18 months now, but this position is long term. We like what ITM does in hydrogen tech and cost reduction, and bought it just above a 52-week low. Last week saw upgrades and downgrades on the stock, but lows still come above a 410 pence. Short position are now exiting, and April result will definitely see the first meaningful jump in revenues. Now, late in the week, we made a few purchases on the back on increased tension with Russia. Oil futures price is above what we first forecast, but over $100 a barrel is not inevitable. Current demand is 102 million a barrel a day, and that's demand that can't be supplied even before Russian trades. We also took a couple of more oil stocks after selling off BP this week. We very overweight on energy, but we took short-term positions in oil companies with greater exposure to oil prices in Cosmos and Phillips 66. Now, final buying of the week were defense stocks, which have already moved through Friday's trading. We took Northrop and Lockwood. Northrop's definitely the pick. I'll not use too much details here, as I'll use it this week on our Instagram analysis.
Well, yeah, I'm hoping it's going to be a busier week. Is that kind of what we're looking at? Next week is going to be a lot busier than what we've been this week?
Yeah, we'll definitely be busier this week. I know you're very excited about Monday and Tuesday, and tons of data expected to have downward pressure to the market, and we expect a temporary diversion of capital flows. Oil will be in focus, but we expect actually all commodities to be very strong. Gold started to move late last week, and while we at the top of a commodity cycle, we could be at the bottom of the rare super cycle. We remain strong on all agricultural commodities, an effect probably of climate change. But we anticipate a busy week for London Metal Exchange. Gold, silver, nickel, and high-grade copper should all see a positive week.
It's ideal that you've touched on commodities as we kind of start touching on people's requests from this week. One of the biggest requests we've had from a few different people has been Premier African minerals. I'm guessing they're going to get some good news due to where we see commodity markets going.
Yeah, house price is up 100%, and just in a couple of weeks, but only back to March 21 levels, most on the back of INS. The appointment of Vascoto as CEO was well received. We can't just pretend that the company is anything other than speculation. The revenues are almost zero, and they aren't a new company. And of course, share dilution over the last year, which is always last resort funding. It's always tough to analyze a company that does so little balance sheet wise, but the stock has a great following of retail investors. Institutions have zero interest, and understandable, because we have a fair value at 0.24, but I won't be surprised to see the stock at 0.52. From there, it's just how many will be looking at closing our profit, basically.
We'll finish up this week on looking at another couple of requests. We will just kind of keep picking these off at random. So this week we're going to have a look at Roblox and also Coinbase.
We mentioned a couple of weeks ago, we happy to open crypto exposure when Bitcoin went 34,000. In fact, we kind of expect to see divergence of Bitcoin and Nasdaq this week, and anticipate flows into crypto. With Coinbase, we were involved pre-IPO and got out on float. and valuation that couldn't basically be justified. I like them at today's price, and they are on our watch list. Their gross margins are huge, but 2022 revenue will be slightly down year on year for a net income at 1.7 billion. They've got a ton of free cash. EPS are estimated at $7.50. The only downside is that you want them $162. Sure, we will compromise at anything sub 170. Right, Roblox. I love this sector. I know you hate it. The current price is down 50% on last November. It might have a bit more to go just based on market exposure, but at lowest 50s, it's definitely a buy. 2022 revenues, they will be up 20% on the year, and although still loss making, it will only be slightly at 58 million for minus 0.01 as EPS. They've done a great job to this point. Cash and equivalents of basically 2 billion with only 200 million of debt. They've got free cash of 600 million. That means there's a lot to like other than broader market exposure.
Well, that's it for this week. Thank you for watching. Do the like, subscribe, comment thing, get in touch. You can see if you guys get in touch, we do make an attempt to kind of address that. We will be back next week. Who knows where we'll be? Will we be in the midst of a war? Who knows? But what we will keep trying to do is guide you guys through these quite big macroeconomic events that are facing us. Thank you.